Here we are, another Tuesday evening, and welcome to everybody. We're just on pre-show mode for a second or two before we get up to the 8 p.m. start. I hope everybody's well, and as normal, the dogs are here, of course, ready to hopefully not make too much noise over the next couple of hours or so. And also, here is the studio view. Damien is teed up, ready to come in over there. We've got everything else sorted out. We've got the chat running. We've got the multi-view running. We've got the other screens that I use for content. And I monitor the output over there as well. So it's all looking pretty good. And we can have a really interesting conversation tonight. Volatility, Santa rallies, tokenization, Japan, AI, so much to talk about. So should be an interesting conversation. Let me take the pre-show off. I'm going to start the show. Be back in just a moment. Well, good evening. Welcome to this live stream on the 2nd of December 2025. Martin North here from Digital Finance Analytics. Great to have you on this evening. And thank you for taking some of your time out on a Tuesday evening to spend it with us. Really appreciate it. Going to have a fascinating conversation even about the markets with Damien. And so much to talk about. Tokenization, Santa rallies, volatility, AI, Japan, inflation in Australia. A lot of things to talk about. So I think this will be a very interesting conversation. As always, you'll be able to put your thoughts and suggestions in. Before I bring him in, let me just remind you that we're not providing specific financial or legal advice. It's a general conversation. We'll moderate the chat, but feel free to throw your questions, comments, suggestions as we go. If you use that Walk the World DFA, that'll get my attention and go into my separate queue. I've also enabled Super Chat. If you'd like to make a contribution to what we're doing around here or get your question top of the list, use Super Chat. Really appreciate those who support us via Super Chat or Patreon or via PayPal. It really helps. And I should add that I can't control whether names come up or the other identifiers come up in YouTube. YouTube just has this weird thing where they're testing different ways of doing it. So it is what it is. So I think tonight everyone's at whatever they are. So that's just the way it's set up tonight. Can't do anything about that. But anyway, we'll have a good conversation. Nevertheless, let me bring Damien straight in. Damien, welcome back. How are you going?
Yeah, not too bad. Yourself, Martin?
Yeah, very good. Been very busy. A lot of people asking a lot of information about households and how they're faring. I've been in the newspapers quite a few times in recent times about some of the mortgage stress and financial stress and things. And of course, we had the inflation surprise. Well, it wasn't that surprising for those who were watching, but the inflation story. And now the expectation of rate rises rather than rate cuts in Australia, which is perhaps not what people want people to hear. We've got, of course, the issues around the AI and the revolution that's going on there and the next phase of the revolution, which I think we should touch on. But I guess what I wanted to get your initial take on is, traditionally there's been what's called the Santa rally at this time of year. And the Santa rally basically says, well, all the traders, they want to true their positions up so that at the end of the year, they flatter their positions. And what that often means is they do all they can to sort of push markets higher. And in fact, if you were to look at the way markets are behaving at the moment, this is the S&P 500, we are, knocking on all-time highs again. So, the question I got for you, Damien, is do you think the Santa rally is intact? Are we going to see more rises, or is volatility going to bite us again? And then the other side of the equation, if it is volatile, who are the winners and losers in a peak volatility cycle like we've had recently?
Right. Yes, lots of questions in there. So Santa rally, I think the first one I'd say on this one is I feel as if this has almost become a bit of a self-fulfilling prophecy in a way now. So 20 years ago, it was, I don't think, I can't remember when it first became a thing, but it feels like the last 5 or 6 years, it's certainly become more and more of a thing. And so I think it's a little bit self-referential when in traders and punters expect the market to go up because of the Santa rally, so they buy in, and then the market does go up, and it's like, oh, lo and behold, And so so I do think there's I do think we are there. The question is, is it real? Can it last? All those types of factors like that. I think the main thing I'd keep coming back to is within stocks, and I'm going to exclude Australia a little bit here because Australia does look expensive, however you cut it. But within stocks, you're basically looking at this whole idea of this K-shaped economy and a K-shaped markets where you've got some going up and some going down. And so the ones that are up are your AI stocks with your high growth, and they tend to be quite expensive. And then you've got a whole bunch of other stocks sitting at the other end, which are not AI, not growing that fast, and are pretty cheap. So I think it would, I did a piece on vaccine makers that we might sort of talk a little bit later as a microcosm, but just another one we were just looking at today. Kraft Heinz is a pretty well-known brand name. Markets are trading on, or sorry, AI stocks are trading on sort of 25 to 30 times earnings, and Kraft Heinz is on 5 times last year's earnings and 10 times if you look at the next couple of years. So you sort of priced at a third of the rest of the market. It's got its own issues. It's not growing particularly quickly. It's going in the opposite direction with some of its growth. It's got truckloads of debt. But if you want cheap stocks that are out there, it's just a question about, are you paying up for the stocks you think are going to grow, or are you going to getting out of stocks that you think are not going to grow? You're avoiding those. And so I think when we start seeing all those, when you start seeing the Kraft Heinz and all these and the vaccine makers and the car companies and all these stocks that are really depressed, when we start seeing them rise, then I get more concerned. But for the moment, the market is being a bit discerning about what it's buying. It can be wrong, but there is at least sort of some I guess it's not just a blind, everything's all going up at the same time type of market.
Yeah, very interesting. And it's worth just reflecting, isn't it? About 75% of global equity value is lodged in the US. It's a remarkable concentration. And if you look at the size of an Nvidia stock or one or two of the other big AI stocks, they are bigger than other stock markets around the world, right? And
Yeah, absolutely.
from a relativity perspective, the center of gravity, or the gravity well, as I sometimes call it, is the US. And so, to an extent, whatever happens in the US is going to have an impact on other markets as well. And I suppose the other side of that is that if you actually want to participate in the momentum, quite often it is the US markets that looks like where you should probably be thinking about. But of course, there are also some significant factors to think about there. For example, we know that Kevin Hassett is now tipped to be the next Fed chair, and Kevin Hassett, of course, is very much in line with Trump in terms of rate cuts, rate cuts, rate cuts. And so if we do get rate cuts in the US, that could give a further momentum to the US markets. The question is that good or not? And what are the implications and fallouts of that? But it is a fascinating question because, in Australia, a lot of people just look into the Australian market. And as you said, it's rather highly valued, I think, relative to what I'm seeing. There perhaps are more opportunities in some segments of, say, the US market, not necessarily AI, but other segments too. So this is a question of portfolio balance and portfolio strategy, isn't it?
Absolutely. So we've got we think about this in terms of how we're putting our portfolios together. And is it worth talking about vaccines at the moment?
Yeah.
Is this, or is this
okay. Yeah.
Yeah. Sure. Okay. Without sort of going too far, too far away from this idea, but I'm using the vaccine sector just because it's a microcosm, not because I think that's it's not a particularly big sector. It's just a microcosm of the entire market for the moment. So you look at these and you say, okay, there's 5 or 6 major vaccine stocks out there.
Do you want to show the screen, or is that what you're listing on?
Oh no, that's all right. I can just talk around. Let me talk around the issues.
Yeah.
So there's 5 or 6 of them around here. They're trading on less than 10 times earnings generally. You can get sort of 7% yields in the sector. Like, they look cheap. And so the big ones, I guess you probably heard all the names during the pandemic: Pfizer, GlaxoSmithKline, Sanofi, Merck, CSL. All these companies that are sort of involved very much in this sector. And it's this really highly regulated sector with a high moat, because they're not like other pharmaceutical products, because you're giving them to healthy people. So when you've got people have a disease, they're going to die. In particular, they're less about saying, okay, what's the harm you're weighing up against the harm it could do versus the benefit it could do. And you're like, well, if the person's going to die anyway, then the harm's sort of, relatively limited, whereas there's upside to it. But vaccines are different and they're going to give them to all these healthy people. And so governments are basically uh, have special sort of liability shields out there to protect the manufacturers. They've got deals out there, so CSL benefits from these deals where effectively governments are paying them to keep these production lines open that aren't really being used because if there's a pandemic, they're going to need them. And so the last thing you want to do is have CSL shut down all its vaccine lines and then have a pandemic and then you can't get enough around the world. So there's sort of these there's a lot more regulation within it, but the governments are also a lot keener on keeping these companies alive and making sure that they're at least profitable. And there's these big barriers to entry because you just don't want to let anyone in there. It's all about making sure that these vaccines are really safe and as the production of it is really regulated. So from that side, you're like, okay, it's an interesting sector. Why is it a third the cost of the rest of the price of the rest of the market? Then you go, well, now we've got RFK Jr. out there, and now he's sort of, is he creating a generational problem with people in the US where, a whole generation will, or sorry, maybe not the whole generation, but a large part of a whole generation will be no vaccines cause autism. You don't want vaccines, you don't want to be vaccinated. You got to do it all with safe, whatever, old wives' recipes and all that type of stuff. They're also out there. Trump's also out there talking about. It's been talking about bringing drug prices down within the US and forcing them to pay higher prices. And effectively, what we've had is the US keeping its drug prices high because it doesn't really regulate the sector, and the rest of the world regulating and paying lower prices. So he does have some argument that the US is sort of helping to fund the rest of the world. And we saw an agreement out was it today or yesterday with the UK, where the UK is agreeing to pay more for some high for drug prices, and so that's sort of a positive for these companies in the sense of, okay, is Trump going to be right? Are they going to get more money from overseas and pay a little bit less in the US and it'll be about the same? Or is it just going to be they're going to be forced down in the US and they won't be able to get cheaper prices elsewhere? There's all these sort of pros and cons towards this sector.
And Damien, just a quick point on the UK. The reason the UK basically is now going to get the National Health Service to pay up to 25% more for US drugs is because in the UK, there is a big pharmaceutical sector of exporting to the US. And what they wanted to do was to avoid tariffs being imposed on those going into the US. So it was an absolute horse trade between the local pharmaceuticals, the NHS, and the US. And it just shows you how complex this is.
That's right. And so, and one of these companies, GlaxoSmithKline, is one of these big beneficiaries from this as well. So that's one of the UK ones. And so and so there's this idea that you've got that, and then overlying that you've sort of got this mRNA that's sort of coming out, and that could very much transform this sector. If you could get 3 shots, they're working on a combined COVID, flu, and RSV vaccine. It's sort of this sector where you got. There's threats to the growth, there's threats to performance, there's positives, there's negatives, but it's so cheap relative to the rest of the market. Or do I buy these AI stocks that are expensive, but they're just growing so quickly? They're just pumping out. Nvidia grew in the last quarter alone at 22%, and just from one quarter to the next quarter. And you're saying, if you've got companies growing, even 20, if you can do 22% per annum. An overpriced stock becomes much less overpriced really quickly. So so you've got that whole thing going on. And so for us, it's about, look, how do we put our portfolios together so that you're not too exposed to one part? And so for me, there's this there's an AI which is sort of the real bleeding edge AI, and I throw things like Palantir into that. Oracle sort of sits on the border of it. You've got some of the latest ones that just listed the neo cloud companies that are just sort of brand new ones setting up these AI data centers. A lot of these are all loss making. If you can get into any of the Anthropics or private equity things into OpenAI and stuff like that, they're sort of real bleeding edge ones, which you're either going to make a lot or they'll be broke. There's sort of not a lot in between within that. The next stage down is what we call a profitable AI. Now, these are the companies that really are benefiting from the AI boom. They're making good money from and their profits have really been growing. And so Nvidia, Google, or Alphabet, as the headline stock's called, Amazon, all these stocks out there that are making some generally making money. They're expensive, but they're not horrendously expensive if the growth keeps going. And so, we can certainly see a path towards saying for these companies that you're still, there's still money to be made within that. So, if you looked at Nvidia, let me just grab the latest stats on that just to check. So next year's on a PE, next year's 25 times, the year after that's 20 times. And so, that's cheaper than Commonwealth Bank, in terms of what you can get on that second year earnings. So, so you've got these stocks where for us, it's about saying, how do I get exposure to those sectors without, so I want some exposure to that sort of profitable AI. And then you've finally got, I guess your more normally priced ones, but you got a lot of value and contrarian stocks like, vaccines, some of the wind sector, and the renewable energy. Cars are very cheap. I spoke about Kraft Heinz and a lot of these quite indebted industrials that you see within the US. And so then it's about saying, well, how do I get the ones in there which I think will stand up if the AI boom keeps going, but also that if the AI boom finishes, that's really going to balance my portfolio. And they're the ones where, look, the vaccine sector's already beaten down. If you see a big fall in markets and they're off 20, 30%, do I think these things are going to go that much lower? Or if they do, if I'm getting a 7% yield anyway, well, I'm happy to sit in a stock that's paying me 7% per annum, until it starts going up. And so, yeah, it's about how do you put your portfolio together with getting enough exposure to the AI without getting so much that if the whole thing comes unstuck, that you're sort of left up the creek, and then also pairing that with other sort of these value or contrarian stocks that sort of sit with your portfolio. So yes, that's sort of how we're looking at it. We can jump more into the AI sector in particular because I think there's how you put the stocks together there is a little bit different, but maybe that's a bit of a different conversation. But yeah, that's sort of roughly how we're looking at how to fit together these markets at the moment.
And to what extent does exchange rate movements, or do exchange rate movements and bond movements impact that portfolio construction?
Look, a lot, but in a lot for in terms of how you're thinking about which stocks you're putting within the portfolio. But then there's a whole class of stocks where the other answer is not very much at all. And what do I mean by that is, say I took a stock like a Microsoft. Okay, so it's listed in the US, it reports in US dollars, it makes money from right around the world. It makes money from Australian consumers, it makes money from European, it gets paid in pounds. It's a global company that just happens to be listed in the US. And so currency movements, it's the US dollar goes down, and so therefore, it's now actually making. It's a bad thing if you're sitting as an Australian investor looking at it because you have lost some money from the US dollar going down. But actually, Microsoft itself, its earnings are going to go up because it's got all these earnings from offshore. And so there's sort of some companies we think of as global citizens, and for those ones, the currencies don't matter as much. But then there's companies where you're like, okay, no, this is a company which has got a primary exposure to the UK or a primary exposure to Europe or whatever it is. And then you can also so that's on one part, and then the bigger ones or the more important ones are what we call the currency mismatch companies, and they're the ones where they produce in one currency and they sell in other currencies. So resources companies are classics for this. You've got so you've got a mine in Australia, for example. A chunk of your costs are Australian dollar based. A pretty big chunk of your costs are probably US dollar based in terms of energy or fuel and stuff like that as well. But then you're selling in all these other currencies, and so it's question and quite possibly selling a lot of it to China. And so when you get movements where in where the currency you're selling in goes down, but the currency of your costs goes up, that causes issues for those companies. And so they're the ones you need to be most careful about when you're talking about investing and worried about what currencies are going to do.
So actually, it does depend on the structure of the company, where it trades, and how it trades, rather than sort of a macro story about, oh, if exchange rates go up, then do X versus Y, right?
Exactly.
Yeah, and I
Yeah.
think that's actually a really important point, right? Because what I get frustrated about are these top line macro stories that come out, talking heads and all that. Another good example of that was the announcement recently relating to AI chips, and Meta is now in talks to spend billions on Google's chips, and that's because, of course, Nvidia has been the main game so far, certainly in the West, but now others are actually potentially coming up with their own chips. And the point about Google's chips is they look to be less power intensive for the power that they give, and therefore could be a lot more attractive when it comes to thinking about the ongoing running costs and things. Now, what that says is that, well, actually, then you can't bucket the whole of the AI story together, because different stocks are actually perhaps behaving a bit differently. So if you look at the trajectory of Google, Google's stocks shot up. You can see how much they moved up very recently. And if you compare that with Nvidia, well, Nvidia's coming down from its peaks. So even within a particular sector, my point is that there are name-specific issues and characteristics, and Google isn't the only one thinking about new chips, and you actually got to cover that quite nicely in your recent AI report.
Yeah, that's right. So, and let me talk through Nvidia's result, because I think there's something. It was very much discussed. So it's probably 2 weeks ago it came out, maybe two, maybe three. Very much discussed as being really important. The whole market was just laser focused on this one report, and we saw the market sort of selling off in the days before it with this. What if it's not good? And I think the thing for me is, look, solid result, guidance higher, a fair bit higher, to be honest. It's one of these companies where earnings just keep getting upgraded and upgraded and upgraded. And so, from all, but really the story within it is saying it's not Nvidia as much as it's the rest of the market that I'm interested in. So if you want to understand Nvidia, don't start with Nvidia, start with the people that are buying their products. And so when you go through the amount that's being spent on these data centers, we saw over the weeks before that, Microsoft, Amazon, Alphabet, Meta, and Oracle all coming out talking what are they spending, how much they're increasing it, and they're really not slowing down in terms of that spend. It's going to be $400 billion this year. It's going to be $500 billion next year. Like, it's just crazy amounts of money that's being spent in terms of these. All the companies are reaffirming that across their earnings call. Yes, we're outspending that money. So they can change those plans, but at the moment, excluding Oracle, all those guys are making money and pouring it into data centers. So effectively, you're watching an ad on YouTube at some point. Google is taking the money that they're getting from watching that ad on YouTube, and they're taking it, they're pouring it into building data centers in the US. That's pretty much what their business model is happening at the moment. So, can you get to the stage where the data centers they're spending too much on it? There's too much debt. All these stuff like that. Yes, we can, but it just doesn't look like we're at that point yet. So then you go into this whole going into GPUs now. Short seller Michael Burry, sort of famous from The Great Short. He's been coming out sort of arguing that, look, hyperscalers they're overspending on profits and they're not depreciating their chips fast enough. I don't know. Look, maybe it's true. Certainly can't see it in the numbers. Like, I look at Nvidia chips from 5 years ago, and they're still rented at prices that you can make decent profits on. Like, you can still make a sort of 20% return by buying 5-year-old Nvidia chips, leasing them out in a data center and making money on it. So, yeah, maybe at some point that'll become true. For me, it certainly doesn't look to be true at the moment. And in a way, given how fast you're growing data centers, it's a bit of a moot point anyway. Is that, look, if the hyperscalers need to build more, hyperscalers are making money on chips. If they need to buy more chips because they're not depreciating them fast enough, well, that's a good thing for Nvidia, not a bad thing for Nvidia. The real bear case is when you start seeing demand slow and depreciation effectively accelerating because utilization drops, rates are dropping, and you're not seeing that same demand for AI, and that's just not it's just not happening yet. At some point it might, but that's and we're keeping an eye on it, but it's just it's really just not happening. So. And part of this is the risk. So, if you take a random sector, and given we've just been through reporting season and listening to all these AIs, all these CEOs talking about their AI strategies, even the ones that don't like AI are still spending more money because for everyone, or not for everyone, but for most sectors, there's some sort of existential idea that they're existential threat that they're facing. And so, you're a logistics company. You're all about trucks and guys and girls picking up stuff, putting it on trucks, taking it somewhere else, and then unloading it. It's like saying, oh, well, AI matters. Driverless trucks are potentially coming. There's driverless, delivery services. There's robotics in distribution centers. There's all these things happening. If you're the company that's not spending any money, and the AI stuff does work, then you might not have a company in 10 years' time. And so even the guys that are like, oh, it's not working, I'm spending all this money, I'm not getting good returns on it, are still out spending more money because you can see the outline of what it might look like. And so that's where we're seeing with these. We've spoken about the circularity issues that we might have, and I think you've got maybe that's your chart you might show, but there's so maybe there's some risks around that, but really for us that whole sector is growing faster now. Nvidia is 90% plus market share. The real competitors out there, AMD's got some, but they don't have an operating system. Nvidia's got the whole suite of from chips to software to how you integrate it and all that type of stuff like that. AMD's got some interesting sort of credible alternatives, but you're going to have to sort of build them and work out how to fit them into the systems yourself. And so it's not this one sort of it's not this whole set that you can sort of fit, you can plug straight in, but worth keeping an eye on. Google's ones are interesting. They've certainly proven in the Google environment. And let me talk energy in a minute because I think there's a whole different story. I want to talk about that. Amazon's got a bunch of chips as well, and would love to use some of its chips, its custom ones, and it would love to use more of it in that. Google's got this sort of push most recently from Meta talking about using it. So I think about Nvidia as saying, yep, it's in the right sector. Still can't see too many cracks or anything like that happening. At some stage it will, but it could be years away yet. And so, but there's risks around it. And so, do I want a little bit of AMD or do I want to own a reasonable amount of Google? Do I want to own a reasonable amount of Amazon? Yeah, I do. I want some hedges on that. It's not a matter of saying, this is the one thing that's always going to rule. I need to keep an eye on what's happening in these competitor markets and see what's happening. And so that's those. On the energy side, a little bit of a different story. Actually, maybe I might go back to you for if there's anything I've missed on that, and then let's talk energy on these chips.
Yeah. So the other factor, of course, is the China connection here with regard to the AI chip story. And we know that there was earlier in the year, a big surprise coming out of China. And there's an expectation of more China chips coming through too. So that's another factor I think that we need to wire into our thinking. Now, there's a debate about whether, in fact, NVIDIA will be able to sell some of its maybe more crippled chips to China or not. And there's a little bit of a swing and a roundabout on that. And we also know that NVIDIA has been lobbying the US government for effectively help, right? And potentially even a bailout or something, right? So they're pulling all the levers. So I have a sort of a thought that, are we getting to the point that the AI story is now too big to fail? So we've got so much money being thrown at it that actually maybe, there is actually an interesting systemic risk in all of this now.
Yeah. Oh, absolutely. I talk about the US, and I've seen a couple of charts. I'm trying to think where I saw them, but there's definitely a couple of charts I've seen that are basically showing, look, if you took out the AI growth in AI, then the US is in recession. And so And we spoke about lower interest rates in the US, and what does a good tech boom love? Well, it loves lower interest rates. It needs capital, whether it's capital just from equity markets or whether it's capital from debt markets. Um, if you see lower interest rates because the rest of the economy in the US is all weak and falling and unemployment's rising and stuff like that, it's making way for this boom to be bigger, the AI boom to be bigger. And so, we're possibly 18 months away from Trump talking about what a great idea it was for him to crash the rest of the economy to give room for this AI bubble to get so much bigger, He's because realistically, these guys need to build these things. They need tractors and equipment to go and do those initial stages, and they need, people to do this. The fact that they're not building houses and not out building commercial buildings and all that means they're available to build these ones or not pushing up the prices. The fact that you haven't got an industrial boom in the US means that energy costs are lower than that. So they're not, energy costs are lower than they would have otherwise been. Energy costs are rising, but they're not, at least they're not out there fighting with all these other ones. And Trump's tariffs ironically seem to be causing the problem that more people are actually shifting stuff offshore, so they don't have to flip stuff back and forth. The question is, especially if you're near the border, if you're sending stuff back and forth across the border 5 times, you've got to pay 5 lots of tariffs. Whereas if you just build it all in Mexico and then bring it all across, you're paying 1 lot of tariff. And so maybe some of this stuff is is actually really helping this boom to get bigger. And I think that's one thing not to discount. The tech boom. In my view, got a lot bigger because we had this crisis beforehand. Not that long beforehand was the LTCM, a big hedge fund, had some major issues, some systemically global issues. And what that meant was, the Fed cut interest rates a lot lower. And so in my mind, that's what helped the AI boom to get, the tech boom originally in the 2000s to get a lot bigger, the internet boom to get a lot bigger. And that's where, could clearly see the same thing, or certainly echoes of that same thing happening again this time.
Yeah, and just building on that and coming into the energy conversation, Christopher Joy wrote a really interesting article in the AFR a couple of days ago, suggesting that actually all of this AI investment could be significantly inflationary, not least because demand for energy, cooling, and all of those things are going up. And the point is, of course, those AI players can afford to spend a lot more on the energy and the cooling and everything else because they're actually making huge returns. But the fallout in terms of higher costs for ordinary people, for example, the cost of RAM in some areas have doubled because they're actually retooling and re-switching into creating RAM for AI rather than RAM for ordinary computers or other small devices. And so there are questions now whether there is actually inflationary pulse directly or indirectly being created by this AI revolution.
Yeah, potentially. And I think certainly on the energy side, and we'll talk a little bit more when we talk about Australia, but just reminding, I think I don't know if this is the last time we spoke or maybe it's 2 times ago, I spoke a little bit about the economics of AI and this idea that if your cost for a GPU is $3 per GPU hour, you're renting it out for $5 or $6 at least in most of these cases. So, and of that $3 cost, say, half of that or more is capital cost. So that's the sunk cost once you've got it. Your actual energy cost is like 7 cents or something like that on it. So if your costs are $3 and $2.93 of that is a largely fixed cost, and 7 cents of it is an energy cost, and you're renting this out for $5, say your energy costs triple. They go from 7 cents to 21 cents. Well, what do I need to do? What's increased by 14 cents? I need to add, I need to stop selling at $5 an hour and start selling at $5.14. Fine. Who cares? The people on the other end aren't really going to care about that size of increase, or maybe I'll just absorb it in the margin, But the net effect is these guys can pay way more for energy, and it doesn't really make a difference to their business case. But if that pushes up the cost for industrial users in the region, if they're paying triple, they're going to feel it, or consumers are paying triple, they're going to feel it, and so. Yeah, it's this weird part with AI where, look, energy is really super important. If you can't get it, it's super important. But actually, once it's installed, they're actually just not very sensitive to the costs. It's a pretty small cost of the overall production of the AI.
Actually, cooling could well be a bigger issue than energy because, of course, that requires water, and water resources are not necessarily infinite.
Mm. Yeah, maybe I'm not as concerned with those. I think I think for the water stuff, look, it's important, but I just don't think they use as much as people. And actually, if you looked at a similar sized, like if you said, "Oh, look, we've got a cement manufacturer nearby or whatever, and we're going to shut them down and set up a couple of data centers," I think you'd sort of look and go, "Oh, well, actually, when push comes to shove, the water usage is not that different."
Yeah, very interesting. Okay, now where do you want to take the conversation forward? I've got a few other things to sort of wander off, but you've probably got more to say on the context.
Yeah, what was I going to say? There's something else on the energy side. Uh, there was something else. Just going to go for that. Actually, let's go to the next one. Let's because we've got a lot to cover, don't we?
Yeah,
Tokenization, Japan.
yeah. Okay. Well,
What's
let's go. Let's go firstly to the Japan story, right? Because the Japan story for me is quite an interesting one. If you look at the current Japan uh, bond yields, they're actually quite a lot higher than they've been. And people are now talking again about the carry trade unwinding. This is actually the 10-year, and you can see it's knocking on 1.858. People are now talking above 2%. The 30-year, if you look at the 30-year, is up at 3.3, which is a lot higher than it's been. And the story of Japan is, of course, that inflation is still well, a little bit high there. They're talking about potentially putting interest rates up. The most recent statement from the governor in Japan, the Reserve Bank in Japan, basically said, "Well, we're probably going to have to put rates up at some point."
Mm.
But there's a really interesting question: is this an important signal, not just for Japan, but more broadly?
Um, a little bit, a little bit. There's a couple of what's the there's that Soc Gen guy, the bear, is Albert Edwards, who says, "Oh, this is the most important thing you need to worry
Yeah.
about
Yes.
is Japanese yen and the carry trade." And so, and it used to be way bigger. So but it's still important in terms of the size of it. So for anyone who sort of doesn't know about the carry trade, so basically what it is because interest rates are so low in Japan, the carry trade's basically you go and borrow money in Japan and you pay whatever 1 or 2% for it, and then you go stick your money in US Treasuries and you get 4% yield or whatever it is. And so and you just pick up the free, it's just a free carry on that. And so the currency things you need to worry about, there's all these other bits and pieces that go on. But by and large, that trade I think it's done almost 13% per annum for the last 4 years. Just literally borrow in Japan, go and invest your money in the US bond market. And so when that starts to unwind, because now your borrowing costs are getting higher in Japan, so now what's happening is you go and sell your US treasuries, then bring it back and go pay off your Japanese debts. And so I think there's some of that's going on in terms of that, which is why we're seeing yields in the US go up a little bit in terms of these, because you're saying, well, why are both going up at the same time? I think there was a good quote from one of the guys, John Alpers, right, was writing in today and just saying, oh, they talk about US bonds going up in sympathy with Japanese bonds, going, well, look, bond traders, they're not an emotional bunch. They're not sort of like, oh, my poor Japanese brethren, let me take some losses as well on my bonds. It's just that bond trade unwinding that's there. The question then comes to how sustainable is this? Is this something that's going to be, we're going to be looking at for a long period of time? What does it mean for Japan? And keep in mind, you spoke about the rates. The US, the Japanese government bond rates almost 1.9%. And it's like, well, that's not a particularly high bond rate. Like it's not a sort of if they're in any real danger at the moment. It's really just talking about maybe they'll actually get to a normalization phase. You do have the government there, new government there, having issues with China, but also doing some quite strong fiscal expansion as well. So the fiscal expansion probably going to keep inflation high. This is probably a good thing for the world. If Japan can get off their low interest rates and actually get some reasonable inflation going and things like that. But are there going to be some financial plumbing issues in the way? Yeah, I think there could be, and especially if we saw it go quickly. The faster we see that Japanese yield go up, the more you start seeing people who are like, you know, hedge funds that start blowing up because they're assuming the spread between Japan and the US would always be at least 1.5% or whatever it is. There's some stuff that could go wrong there. Is this enough to bring some of the world down? Is this another LTCM, like a long-term capital management? Look, it could be, but I think the Fed's so ready to run if there's any signs of any danger with the fire hose. Yeah, whereas 20, 30 years ago when we were having those problems, the Fed would see a problem, consider it, work out, do we want to bail this person out? Don't we want to bail it out? What are the pros? What are the cons? Um, are we going to create like a problem here for future ones because people are expecting to bail it out and all these things like that? Nowadays, they just go, oh, liquidity, bam. What's the problem? Fire liquidity at it. Work out later whether we should have done it or not. And so, yeah, could there be problems coming out of Japan? Absolutely. Do I think if there is any, that the Fed will hose it off pretty quickly? Yes, I do. Um, and we're still talking about relatively low rates there rising. I mean, there is an issue about saying when you say, oh, the Japanese government's got hundreds and hundreds of percent of the GDP in loans, and what does that mean? And does it create all these problems for it? And I go, well, yeah, but the net effect is much lower. So most of those are actually just owed to the Bank of Japan. So it's the same as me, for example. I just loan $100,000 to my wife, who then puts it in her bank account. And so what the net effect for my family is, minus 100,000 plus 100,000. We're in the same position as we were the day before. And if anything happens, we can just switch it back and we've cancelled that loan. And so Japan's largely in that position. Its debt is under 100% if you net them off. And so when you look at things like this and you're like, oh, all of a sudden they need to pay 1% more on their debt. It's like, yeah, well, more than half of that's going to themselves. They just turn around. How am I going to pay for it? Well, I'll take the money we get from the Bank of Japan and put it back into the government account. So yeah, I'm not as concerned about Japan in the long term. It's worth watching for short term problems that might arise.
And Cookie Boy asked a question a little while ago, should we be worried if Japan and China start to sell US treasuries? And there's 2 points I want to make. One, of course, is when you look at the value of treasuries, well, the exchange rate has an impact on that. But also the fact that there's a lot of treasuries still being issued, which still seem to be being bought. So, maybe it's not such a big deal.
Yeah. And the real question for these is, what are they doing with the money?
Yeah.
Because if China, for example, says, okay, we're going to take our money out of US treasuries and bring it back to China, then the Chinese currency is going to rocket. So because they're basically saying, yes, let's take $1 trillion out of the US and go and sell $1 trillion of US and buy $1 trillion of $1 trillion US dollars of yuan. All of a sudden, the Chinese currency rockets up. They all of a sudden can't sell any of their, they go from having cheap goods to having expensive goods. They can't sell. They start to run into problems. It's not as simple as just they'll sell the assets. Can they put it into other assets within the US? Well, maybe, but there's not a lot of cheap assets around, and so then they're basically taking equity risk or whatever it is within that. So yeah, so it's there are some short-term issues, and I do think as well the ones we're seeing at the moment, this carry trade unwinding from Japan is private investors. It's private investors who have borrowed in Japan, lent the money to and bought US treasuries with it. Now they've just got to reverse that trade. They've made lots of money from it. There's no real danger of these guys going bust, certainly in the short term. As I said, they've been making 13% per annum for the last 4 years. They've added probably almost 50% to whatever they. If you borrowed 4 years ago, you've just borrowed 100,000 4 years ago. Now I've got 150,000. So now I've got to reverse that trade and bring it back. But it's not like it's not like they're losing money or they're going to be going bust because of the problem. Yeah, unless they sort of put the trade on, extremely recently.
Yeah, and quite a lot of that money could well be going into gold, right? Gold futures up at more than 4,200. It was a little higher a little while ago, but very interesting to see the correlation there. now broken down completely with Bitcoin, which of course is going in the other direction. I was listening to some the other day suggesting that
Yes.
some of the liquidity that was there previously was actually being sucked out because of what's happening with the carriage rate, et cetera, et cetera. But there's still a lot of liquidity flushing around the system. So maybe actually people are making different bets in terms of where to place their money.
Yeah, that's right. I'm going to do a podcast on Bitcoin this week just to sort of get a bit more into detail. So, so that's on Thursday for anyone who's around. But yeah, I think there's and the other thing to keep in mind with this as well is sanctions in on Russia and sort of stopping some of the money, some of the oil flow money. There have been intimations that they're actually expending some of their gold and spending some of their Bitcoin and stuff like that. So I think the way I think about both these assets is uh, there's buyers and there's sellers out there. A lot of the buyers have been central governments and certainly from emerging market companies and countries that are otherwise might have bought US treasuries but are now just looking at it and thinking what are the risks there. And so the real question is what they're doing with their money. Um, the Bitcoin one, yeah, look, there's definitely liquidity issues there. There's a whole bunch of, Trump's obviously he's been quite keen and issued quite a lot of changes to the structures to sort of help stable coins along and things like that. Um, I think maybe a lot of people bought in ahead of those thinking this is going to be great for it, but maybe it hasn't been or it's been, the effects have been overestimated as to what they're going to be. I think.
Yeah, and just on that, it's worth just spending a moment or two before we get into tokenization on the Genius Act. And this post the other day was calling out the fact that everybody thought the Genius Act was about crypto regulation, but actually there's something else going on, and that's of course the link of treasuries to stable coins. Essentially, allows the Treasury to issue treasuries without going through the Federal Reserve and backing them against stable coins. And there's a large amount of liquidity being created by that. So, people are saying, actually, this is probably the real secret to what's going on here. And in a way, it's reducing the power and effectiveness of the Federal Reserve.
Yeah, well, it's one thing as well to say, and it's another thing to say, well, look, is it getting US debt costs down because you're basically saying let's now all these stable coins have to own they have to back their assets with something solid.
Yeah.
And so now they do have to own US treasuries. So now I've just found another person to buy US treasuries, which in theory should push the yields down further than what they might have otherwise been. So that's interesting. And also I think the largest one of these stable coins doesn't meet the criteria. So when you look at them and say, okay, well, there's this great act out there, this Genius Act, in order to be able to say that they can now, these guys are now more legit and they can move into mainstream finance and saying, well, yeah, but they don't meet the criteria. The criteria basically says you've got to have it's sort of semi-banking ones. You basically, if you're going to issue these stable coins, you've got to have proper assets behind it. You can't just stick, Bitcoin and behind the asset and buy some some unlisted debt somewhere and things like that. It's actually saying you do need genuine assets that sort of fall into the categories that are effectively US treasuries and cash. And so so that's if your biggest player out there can't meet those criteria, then it sort of shows that there's sort of more regulation coming through into this and it's not it's not as different as what you might thought of it being. And part of that whole thing is like, you're buying this asset in order to get away from the financial system, and then you need the financial system and its assets to back it in case you lose it. So
my immediate reaction was they've just changed the rules a little bit, but not dramatically. It is not fundamentally any different from what it was, but what it is doing is creating more liquidity. More liquidity, one, increases debt, particularly government debt, and two, is potentially inflationary.
Yes. And so that's not a bad jumping off point for tokenization, do you think, then, is it?
Yeah, absolutely.
Or is there anything else?
No, exactly. I was setting it up for this perfect conversation. So interestingly, The Economist reported that Larry Fink and Robert Goldstein, are talking about, and they actually was talking about here, about how tokenization could transform finance. And ledgers haven't been this exciting since the invention of double entry bookkeeping, they started out. And then, of course, Larry Fink, in his 2025 annual chairman's letter to investors, talked about the democratization of investing and argued that tokenization is democratization. It's basically a way of allowing more people, every stock, every bond, every fund, every asset can be tokenized. If they are, it will revolutionize investing. Markets wouldn't need to close. Transactions that currently take days would clear in seconds, and billions of dollars currently immobilized by settlement delays could be reinvested immediately back into the economy, generating more growth. And then went on to say that most importantly, it could make investing more democratic. It can democratize assets. It can democratize shareholder voting. It can democratize yields. One day, I expect tokenized funds will be as familiar to investors as ETFs, provided, he says, we can correct one critical problem: identity verification. So there you go. You've got the two sides of the story here. You've got the tokenization, and then the question of, well, you've got to have digital identity to make it work. Takeaway is clear: if we're serious about building an efficient and accessible financial system, championing tokenization won't alone suffice. We must solve digital verification too. And then the BIS, just to give you the other side of the story here, the BIS, the bankers, as it were, the central bankers, published this paper recently, The Rise of Tokenized Money Market Funds, and specifically said it's fast growing, particularly the tokenized money market funds, fast growing collateral, caters for decentralized finance, gives rise to risk that mirrors and potentially amplifies those found in conventional money market funds. And then they go into some of the issues with regards to the constructs between the ledgers and the various players and how it all works, and say it's a bit complicated. And then, by the way, just to finish that out, HSBC is to offer tokenized deposits to US and UAE citizens. So there's something important here. But the question is, how important is it? How much of this is just noise? How much is Larry Fink and co just pushing their barrow again? Or is this going to fundamentally change the face of investing? What do you think?
Yes. Let's talk about this pushing your barrow. So they are now some of the largest owners of private assets, private debt, private credit, and private equity. BlackRock's made a big push into those. So they are talking their own book in a big way. So and why am I saying that? Everyone's going to talk their own book, and I'll talk some of mine as well as part of this comes. But it's a big chunk of it is private. These private markets, and they're talking about saying, "Oh, isn't it great? We can get all this access to private markets." And a lot of what these new finance guys are doing is what we call regulatory arbitrage. And so what it means is we've gone and created regulations, and those regulations have a cost. So by putting on these, whatever it is, so let's say we're talking about our banking system, and we're guaranteeing the first $250,000 if things go wrong or something like that. That's got a genuine cost to it. There's that, they need to put some money away to factor that. If you can get around that, then I can offer a deposit product that's cheaper, and so or pays better rate of interest or whatever it is. And it's saying, well, yes, but if you've lost access to the regulation that then provided that, then that you've all you've done is got around the regulation and then save the cost of the regulation. And mostly as well, the companies are not they're not giving that all back. They're taking a chunk of it. They're basically saying, regulations costing this much, or whatever it's costing, we're going to take half of that ourselves, or 90% of it ourselves, and we'll give 10% back as a cheaper product to the customer, and everyone's happy. And it's like saying, yes, but now we've just got around the regulation. And so now you've got to go and create new regulations for it. And so I want to talk through some of those ones with what they're talking about. So they talk about the cost savings in terms of transactions. Okay, so that's one thing. So we have public markets, and if you were talking about this to me 60 or 70 years ago, then yeah, public markets were expensive to transact. You're probably paying 1% more when you transacted. Nowadays, so we trade all our portfolios at 9 basis points, so it's 0.09%. Realistically, a bad trade You can lose point 0.1 on a bad trade. You bought something at the wrong, slightly higher or slightly lower. You're probably going to, the spreads are going to be point 0.1 or more. Like you were talking about fractions of a cent. So can I turn that point 0.9 into point 0.8 or point 0.7? Sure, but you're not even going to notice that. We're talking about, 1 or 2 cents on a $10,000 trade. Like we're really at the stage on the transaction cost in public markets where it's just not a factor. Now, could you cut down on the speed and the transactions? Like you spoke about, property, real estate was one example. You got these unlisted real estate things, and we'll save all this money on the transaction costs. And it's like, yeah, but most of these real estate transactions have stamp duties, and then some of the commercial stamp duties can be 3-5% you pay on some of these commercial stamp duties. Uh, the the listing costs. So I mean, if you took an average property trust, and you went, okay, so average unlisted property trust, and you said, let's add up what they're paying a stamp duty and commissions and all these setup charges and things like that. You're talking, it might be 7 to 10% for the average property trust. So you stick $100 in, if you've got $93 left at the end of it, you might be happy about that whole thing. The transaction costs within that, yeah, there's some transaction costs, but they're a small fraction of a percent. Like we're talking, maybe that's 0.5% on it. So you're like, it's really not a major, like it's all these other costs that are causing the issues within that. So saving speed and paperwork, yeah, there's some benefits to it, but it's not really that major. What you are saving with some of these unlisted assets is you're saving the compliance costs of being a listed company. So I get to go and buy this unlisted property trust rather than going onto the stock market and buying a listed property trust. So the unlisted one doesn't have to have continuous updates of what it's talking about to the market. It doesn't need to have the same compliance. It doesn't have the same audit. It doesn't have the same public board of directors and all these things like that going on that sort of goes into a listed company. And so what he's effectively saying is, well, we can try and make these private assets more like public assets by making it so you can trade them much faster. And saying, well, but do you want to? And if you do want to, why don't you just go into the market we've already got, where we've already got regulation that's meant to be there so that when you can trade these assets all the time, he's talking about trading them 24 hours, you've actually got public markets with the regulations and the rules in place so that people aren't cheating you. You don't have private guys who know private information in private assets selling on a 24-hour basis to people who don't have the information. And so, so for a big part for me is like saying, well, I can see the benefits of tokenization, and I can see it's going to save some costs, but it's not going to transform listed markets in a meaningful way. Like we're talking about, the trade costs are already so low. We're talking about fractions of a cent. It's really just not going to make a difference. If you're talking about unlisted markets, a lot of it is basically saying, oh, can we bring all the convenience of listed markets, but without all the regulation? And if you're saying, well, if that's your goal, then why don't you just deregulate all the listed markets, and get rid of all these regulations if you don't want them? So I guess that's where I think a lot of this is a regulatory arbitrage. So they're just trying to get more of the benefits of listed markets and not have to deal with the regulations that go with it.
Well, it's interesting that a number of analysts have said that the biggest risks in the financial system these days is the private credit markets, because
Definitely.
Nobody knows what's going on. There's no disclosure of what's going on there, the losses, all of those things. And more of markets are going into that private sector simply because, well, guess what? People can make
less
more money.
Regulations, much higher fees.
Yes.
Like you want to try and sell an asset on, like, I mean, we charge between like 0.165 on our assets. So 0.165%, and our most expensive ones are 0.64%. Most private assets you get in private equity are going to be charging 1% at least, probably 2 or 3, and they can quite often have all these management contracts behind it that you just don't even see, where they're like, oh, well, we're providing accounting services at some outrageously, marked up price to these guys, and we're providing these other services at directors' fees and all this other stuff. We're getting paid as management consultants to these as well, that we're not including in that fee because the company's paying it, not the investors. And so, private markets are great if you're a private equity guy and you want to make lots of fees. There's, so one of the other benefits they spoke about in terms of fractionalization, we can allow people to. We've got fractionalization. Like within you come to a Nucleus portfolio tomorrow, I'll sell you 0.0001 of a Google share. If that's what if you stick $100 in, we'll go and buy the shares in fractions of a share for you. Like it's available. It's available on listed markets. So yeah, I do think there is a danger in these unlisted markets. I think, if I was going to pick what the next big blow up would be, there's a bunch of different things, and Trump could tweet or change something at any time, but the most obvious to me does seem to be private credit or private equity. There's just been so much money's gone into it over such a short period of time that 20 years ago, the private equity guys, when they're buying companies, they did get some of the best companies. They take these things private. They've got all these things to choose from. They can do whatever they want. Nowadays, there's so much money in that sector. There's these guys sitting around. What are we going to buy? We've got all this money. We've got to buy something with it. We can't charge because we're charging fees on it. We don't. Otherwise, we'll have to give it back. So let's just buy whatever buy whatever we can with it. And so, I do think there's a potential for blow up and all those issues you spoke about, and particularly the private credit market where there's private credit funds out there. I've seen their prospectuses talking about, I'm a private credit manager. I've been a private credit manager. I've been managing this stuff for 15 years or 16 years or whatever it is. And I've got all this experience and we're going to manage money really well. And you go, well, 16 years. So you started in 2009, maybe 2010 after the last big credit crisis we had. So you actually haven't been through a full cycle. All you've seen is the sunshine. And you've been, the whole time we've been, reducing debt covenants and all that type of stuff. I want somebody who's been, who's seen the cycles, who's made the mistakes in prior ones and knows that this is what it's about. Like, it's not about just giving money away as cheaply as you can and getting it back. It's about saying, no, I need to make sure that when the proverbial hits the sand, if we do have a recession, that I know I've done the covenants and I can actually go in and get the asset, as much of the assets back as I like, or as I can, sorry, rather than be sort of left on the end. So I do think there's a big danger. And I think very much that Larry Fink is just talking his own book, and he would love to have regulatory arbitrage where private assets get all the benefits of public markets without any of the regulation.
Absolutely. Well, I believe that there's a lot of sort of half stories being told about this, and I think there's an agenda, and it's important that people understand what that agenda is. It's one being propagated, by the way, again, amongst many of the talking heads. But of course, they've all got vested interests, and that's what I keep coming back to. You've got to understand, what are they motivated by?
Yeah. And so the other thing was they loosened up some of the rules in the US. This was another Trump one, loosened up some of the rules about who can buy private equity.
Yes.
And now private equity can advertise. Yes. And so the thing is with this, and this is the stuff that scares me, is that in a big picture sense, I've got the numbers wrong, but, just think about this in ballpark figures. Say there was $100 billion invested in this sector back in the early 2000s, and they were out there finding these assets and investing in these groups of companies. And now there's $1 trillion or $1.5 trillion or something invested in these assets, and they've run out of people to sell them to. And now they're like, oh, well, can we change the regulation so we can sell them to ordinary people? And as so you've got these big pool of assets, and all of a sudden you've got people wanting to get out, like a lot of the big endowment funds and everything who bought these things back in the early 2000s when there was only $100 billion invested and they got all the best opportunities, and now looking around going, we're making crappy returns on our existing ones. We want to start selling down our exposure to this. We can't find anyone to sell it. So if we get the regulations changed, now we can take, the smart investors can go and sell their units in these funds to the dumb investors coming in because they've just seen an ad on the TV and get these guys out. And so that's my concern, is that the people in the know are looking for the exit now. And so and changing regulations and trying to get more people into that is generally a sign that, look, we're reaching the end game in that sector. And as a sort of slight aside, but on a similar note, that's what I think one of the danger signs is going to be for the end of the AI boom, is when you start seeing all these AI companies going public, and you'll see OpenAI is going to list for $500 billion, and they're going to be talking to you about, Martin, hey, look how we just made $500 billion. We're going to make another $500 billion over the next whatever time period. Here, Martin, just buy my shares at some overpriced amount. That's when you get concerned. Like at the moment, they're all trying to keep the money they're still trying to go, oh, we're doing private rounds of capital raising. We're trying to keep it, we don't want all these investors. We want to keep ourselves all off the market. When they start flooding the market and about explaining how great it's been and how this is your one chance to start buying in on the AI boom, then that's your time to go, okay, the smart guys are starting to sell to the dumb guys. So let's try and let's think about whether it's reaching the end.
And I'll add there on the AI side, just briefly, of course, some of those AI companies are now issuing bonds rather than actually funding their investments out
True
of
private
the cash
equity.
flow. Right? Sounds familiar?
Yes, I think actually, maybe that was one charter. Do I have that one? There's Blue Owl is one of the ones that's a bit of a they're thought about. I don't know if you can bring up share price charts relatively easily, but they're one of these guys
What was it called? Blue Owl?
Blue Owl. Oh, actually, I think I've got
Hang on.
one here I can share. So they are invested in private debt, and a lot of the private debt is lending money to AI centers, data centers. So they're sort of a bit of the epicenter of a number of different themes.
Blue Owl Capital.
And so I've got a chart up on mine just showing. So this is just for the last 4 or 5 months. So basically since July 1.
So
yeah,
that's the one.
Blue Owl Capital. Yes. Yeah.
So it was.
So they're sort of a bit of the
up here, and now it's down here.
Yeah, they're sitting at the epicenter of one of these. They're down about 40%. But if you look at all those guys, KKR, Blackstone, Apollo, all those guys down sort of 20, 30% over recent months. Along that same ideas, look, there's some stuff going wrong in this market. Blue Owl's a bit further down, and they're a bit of the poster child because not only is it private credit, but it's private credit. A lot of it's to data centers. Now, I haven't got as much concern over the data centers at the moment, but it sort of feels as if it's the epicenter of both themes in terms of that. And I think the private credit one's will come to a head at some point. I think the private credit to data, I think the data center one will also come to a head, but I think you've got probably 12 to 18 months, maybe more than that. So
now, talking about things coming to a head, let's just switch the track slightly and just talk about China briefly, right? Because there was more news last week with regards to the China story. And in particular, we had the now the property private crisis alert with Vanke, one of the largest real estate developers in the Middle Kingdom, seeing its US dollar bonds plunges 60%. And despite repeated efforts from state-owned Shenzhen Metro to stabilize the company, free fall continues. This is the next stage of the property correction in China. And I think this is something which, again, people need to be aware of because the implications here are quite significant.
Yeah. So the question has always been on these, and I'm surprised that when we saw that fall a couple of years ago where they had that similar type of fall, and then effectively the most of these things were bailed out or effectively or given the implication that the Chinese government would back them. And I was always worried about the US dollar ones most on that. It's like the question for them is saying, well, if we default on local debt, then we start causing problems. So if Chinese authorities talking about, do we bail these things out or do we whatever? If we let these companies default on local debt, well, that's other people in the chain who won't have that money. They'll then, these other industrial companies will start falling over. That could be the dominoes that start everything falling, to the whole thing coming out. So I've never been as concerned about them, and I've always been a lot more skeptical that they'll bail out the foreign debt because if they look at these companies and go, fine, there's a bunch of foreign investors who invested in these Chinese companies, we're going to default on them. What's the danger to the Chinese economy? Not heaps, I don't think. And so they bought bonds in a company that looks like it's going to go bust. And so if that means they default on those ones, and then whatever happens within China that they manage to smooth over the domestic ones, then I think that's there's two parts to that. One is it's the structure of the financial system. Where's the risk? You might be looking at Chinese bonds and US bonds, but I don't think they're facing the same risk. Chinese bonds or US bonds for the same company, I don't think they're facing the same risk. And then secondly, yeah, more signs that that property market is just not going anywhere in China. But they do want it to drag out, in my view, as long as they can. I think they sort of they had that choice. What it was 5 or 6 years ago. Do we want to have a short, sharp crisis, get this whole thing over again, similar to what, say, happened in Ireland or the US or Iceland or whatever it is? Pick one of those where all these companies, these guys borrow too much money, they're all going to go broke. We're going to let them go broke. A bunch of people are going to go. We're going to try and then we'll have a crisis, but we'll try and make it short, sharp, and then we'll get on with our lives. Or we're going to go down the Japanese route and just try and bail these companies out and extend and pretend and just have this long rolling crisis for years and years and years. I think they've chosen the long rolling crisis. And there's always a danger that we go down to these an acute crisis. But yeah, I'm watching it with a view that I suspect they'll probably extend and pretend again, and we'll just keep going on with this, long drawn out thing of eventually getting the Chinese property back to a more reasonable level. But it is well worth watching these ones in case it turns acute, because if it turns acute, that's real big problems for the Australian economy.
Absolutely right. And the question of the Australian economy and inflation is quite relevant, and it's connected to what's happening in China, but also what's happening in Australia. We had those inflation numbers that came out last week, which were a little bit up on what people thought, but the trajectory of expectations in terms of rates ahead have really switched around significantly, and now everyone's now talking about not rate cuts but rate hikes. And in fact, there were articles suggesting, well, maybe the RBA cut a bit soon, and maybe they shouldn't have. And is it we're actually are we going to see the rate hikes coming next year? And the article actually here was, did the RBA cut too quick? Is now back in vogue. My observation here is those inflation numbers, of course, are all over the place because of government intervention and policy. And we had a significant pull down in inflation before the election because of the electricity subsidies, both state and federal, for the various elections. And so no surprise when those come off, then you're going to see the inflation rate start to pick up again. But the problem that I'm seeing is the inflation pulse seems to be more sustained, and it is changing fixed rates. So the fixed rates now on offer from the banks, mortgage rates, are actually higher than they were. You can get a term deposit with a higher rate. So money markets have now swung the other way. So I'm trying to get to the point of, well, so what's really going on here? Is this a significant inflection point or just a temporary blip? What do you think?
I think it's probably a temporary blip, but I do want to couch that in a different. I want to spin this around and talk about it in a completely different light. So what I find interesting about where the RBA is sitting at the moment is there's sort of four big areas that they don't have much control over at all. So housing's one. So we've got these, the 5% down mortgages coming out, pushing up housing prices. Immigration, we're running these massive levels of immigration, and so constraints on infrastructure, housing again within that is sort of helping to drive some of those inflationary numbers. Energy costs, where we've effectively thrown ourselves to the wolves. We've said, yes, we're one of the world's biggest energy exporters, but we're going to open ourselves up to world prices, and we're going to basically let an energy cartel dictate prices to us. And then finally, I'm going to put this the right way. So this is because, and keep in mind, they're all government run. This is government policy. That's effectively government policies driving up housing, government policies to bring in immigration, government policies letting energy go through, and in a way, wages as well. Insofar as wage growth hasn't been too bad, but private wage growth has been pretty bad. Public wage growth has been pretty good, and public wage growth is where all our jobs are coming from. So we've got all these jobs coming from NDIS and other factors that are going through here. So we've sort of got the RBA where we've said, right, well, we've got this much smaller part of the economy you can actually affect because with interest rates. So we've got the government, pushing the inflation levers up on all these other things. and then basically going, well, you've got this one lever you can pull, which is your interest rates. You try and sort out the rest of the economy and try and have the whole thing balanced for us. And so, in a way, I feel a bit sorry for the RBA in that, look, it's government policies driving them into this. But I do think it's a factor now of saying, well, so what do they do? Do you sit there and say, okay, we've got government policy driving all these in the wrong direction? But look, energy, we're at the whims of we're at the whims of world markets. Raising interest rates ain't bringing energy prices down. Um, we've got the immigration part. Raising interest rates isn't bringing immigration down. Maybe we can do something on housing, but now we're like, now we're talking about trying to crash the housing market in order to try and bring inflation down. But I think there's a little bit in that. And then the wages side, well, we've already got quite weak private sector wages. How much weaker do we need to make those private sector wages so that we can bring the rest of the economy in? So so from that perspective, we've got that. And then sitting outside that, you've got this China issue going on where we know we've got lots more iron ore coming on with this Simandou project over the next little while. We know we've got a weaker China and potentially problems in the Chinese housing market. If that then implodes, what does that mean for the rest of the Australian economy? I do think there's the net effect is my expectations based on where we're going is I think we'll see this inflation stuff will wash through a little bit dependent upon immigration and housing, but I think that's probably pretty set anyway, and it's the rest of the economy could sort of subsume that in either direction, and so I probably think we're still looking at lower interest rates over time, but if government doesn't change its policy and keeps all these things going, then yeah, the RBA is just going to have to raise rates because the government's not doing the right thing in all these other areas.
Yeah, and the point to underscore, Chalmers was spinning like mad. I call him Spin Jim at the moment because he seems to be having an excuse for why everything is not going the way that he wants it. And it's patchy. It's spotty. It'll be fine. So he's definitely going on the tactical route. But some of the economists are now beginning to say that maybe there's more to it. Energy prices, of course, very significant, but also more broadly as well. And the point to underscore, and you touched on it, was a lot of the inflationary pulses are policy consequences, right? So this isn't just pure economics. This is actually the government setting immigration where it's setting in terms of the momentum there. It's the government doing stuff in the energy system, or not doing stuff. They should be doing stuff in the energy system.
5% down home deposits.
5% home deposits. You took the words out of my Claire O'Neill's non-strategy. So it's fascinating and interesting. In the UK, we just had a budget in the UK, and there they ripped out some of the policy costs from the energy bill because for the years and years and years, people in the UK have been paying between 10 and 15% of their energy costs towards policy, allowing for insulation of homes and writing off the bad debts from earlier cycles and things like that. Well, that's now been whipped out, and that's now been put back into general expenditure. So the inflation rate for electricity will come down, but those costs haven't gone away, right? They just moved somewhere else in the pot. And so there's a fundamental economic problem here with regards to government expenditure versus government income. That's one of the reasons why the tax take is continuing to rise as a relativity to the GDP, both Australia and in the UK. And so, you come back to this issue, the RBA is almost helpless. They can pull the lever, but actually, what's it connected to?
Yes, yeah, that's right. If you can pull the lever and you can affect 75% of the economy, then I only need to pull so far. But if I'm only affecting 40% of the economy, well, I've just got to pull it that much further in order to get the same effect.
Yeah, exactly right. So in the light of that, and in the light of the fact that we've got the governments and the policy, running in a particular direction here, from a portfolio balancing perspective, invest in Australia or invest in the US. What's your thought?
Yeah, look, and then the pricing. The pricing is the major one on that. So I struggle to see the growth coming out of Australia. I can genuinely see the growth in these AI companies, and I can see it. So I can see it. So I know what I want to pay for. Now, do I want to pay 20 times, 2 years out earnings for Nvidia, or do I want to pay 22 times 2 years out earnings for CBA? It's a there's it's not like I'll pick the one of the one of the most extreme examples, but it feels like a lot of Australia is a lot like that. So Australia, I'm just trying to be very circumspect about what am I getting? Am I actually getting the stocks I want? How much am I paying for it? What's the quality of the growth you're getting? And Australia just keeps struggling. It's just really hard to find companies that are anywhere near a reasonable price. Whereas I feel as if still in the US or certainly global markets, I guess, I've got this choice between overpaying for stocks that have really high growth and exposed to the AI sector, or picking up some quite cheap stocks that have got some growth problems or debt problems. And so that's the part is sort of I'm bouncing around and going, okay, well, I can see I've got a choice. Whereas I feel as if in Australia, I'm like, well, I can buy quite expensive stocks or very expensive stocks that just have a little bit of growth, or I can buy expensive stocks that don't have much growth. And I'm like, well, just a minute, where's my cheap options? They just don't seem to be there. Whereas and I'm not getting, and when I'm buying the growth stocks, I'm just not getting the same type of growth. Yeah.
Yeah, and it's worth saying if you look at CBA, for example, which was obviously one of the significant peaky stocks, knocking on 190 there, now down at 150, and the latest results weren't. They were okay, but not that flash. This is meant to be the sort of the kingpin, and the other banks are also back down as well, and even Macquarie, which has the international exposure, is down too. So the interesting observation here, is prices do seem to be still stretched relative to returns. And I guess as you sort of come into the end of the year, and this will be the December show. We'll have a show at the beginning of January, which will, I think, be a bit of a review and a little bit playing forward. But it seems to me that this is an opportunity for people to think about their portfolios and just ask the question about, have I got the portfolio balancing right, taking account of the various things we've been talking about tonight? Or is it now an opportunity to sort of stop and think, hang on a moment, where am I going to place my bets? Because it is about bets. What if I'm wrong? There's a lot of uncertainty out there. We don't know what's going to happen with the Ukraine-Russia story. We don't know what's going to happen with the Trump tariffs. Are they going to be swept away because of a court ruling and then reintroduced through the back door? We've got a new Fed chair being introduced quite soon. We've got questions of the China story. We've got questions about economic growth in many Western countries, and of course, including in Australia, that is looking pretty anemic. So, a bit of an opportunity, perhaps, to sort of ask the question about how am I placed and what should I be doing about my portfolio?
Yeah, and so so I've got lots of things about interest rates and all that type of stuff like that. There's all these things that go into it, and we spoke about it. But I think the one real big question you need to ask yourself is, how sustainable is this AI boom? Is it all going to come unraveled within 6 months? Because if it does, then there's trouble. There's big trouble coming for a lot of these companies. If it's going to last another 5 years, then paying 25 times or 30 times for Nvidia, and the boom goes for another 5 years, it's fine. Like I'm going to get with the growth rates they're getting, I'll be back to single digit PEs in a few years' time at current prices. And so that's the real measure for us. We think it's going for it's hard to tell how long these things are going for, but I think we can certainly see all signs look to be there's no real cracks in the edifice at the moment, and that reporting season was pretty strong for all that sector. And so for us, it's saying, well, let's hold on where we can, and keep looking for opportunities within that, and keep looking for sort of danger signs that it's all turning. So assume that this boom is real until we get signs that it's not, because if you get another 3-4 years of it, that's a long time to be sitting on the sideline, sitting in cash, not sort of taking advantage of these returns that you're getting at the moment.
Yeah, and then just to sort of close that out and say that the beauty of the portfolio tools that you offer are people have the ability to be able to take control themselves, or if they don't want to take control themselves, can push it back to basically somebody who understands what's going on. And the flexibility there and visibility is one of the reasons why you and I team up and talk about this stuff.
Yeah, absolutely. And so what Martin's talking about, so the idea is that the word Nucleus was all about saying we want to have these central portfolios for you that are diversified, and blue chip stocks, mixture of quality and value, or you can just get the cheaper ones and get the just the index provider. So we provide that to you, and then give you all these tools to let you surround that. You can cut stuff out if you don't like it. Say you work for a company, you work for BHP, and you're like, I don't want to own any more of that because I already work for the company, or I don't want exposure to the banks because I've already got shares in my own name for those ones. You can just cut them completely out of your portfolio, and then you can add extra things in to say, look, I want some extra cybersecurity. Oh, I really want uranium or gold or more AI or whatever it is that you want sort of sit around that. You can then add those in. So the idea that that you can make that your whole portfolio if you want, all the little bits and pieces you like, or you can just say, no, I'll let Nucleus do 90% of this or 95%, and I'll do the icing on the top.
Absolutely. And just a reminder also to download Damien's AI report. There's a link in the comments below. It's a very, very good report, very thoughtful and very thought-provoking, and I do recommend you grabbing that. Damien will be back for the first show of the new year, I think it is, and we're going to have a little bit of a what happened, but what's more likely to happen in 2026, and that I think will be a really interesting conversation. So join us for that. Damien, thank you so much for your time this evening. As always, really appreciate it. Always love throwing around the ideas with you and getting your passionate reactions, which is absolutely great. So thank you so very much. And I should say to you, have a good Christmas meantime, and I look forward to catching up in early Jan.
You too, Martin. Yeah, great to see you again.
Okay, take care. I'm going to take you offline and close the show. There you go. Hope you enjoyed that. Very interesting and insightful from Damien, as always. And please like, subscribe, and share the show. As always, we've got the dogs here. They didn't make too much noise, I'm pleased to say, which was good. And they are pretty much flat out now. Look at that. Perfect posing. I didn't set them up. They just ended up like that. So there you go. And just to say that I'll be on next week as normal for my next show. So check out that. There'll be recorded shows each day of the week up until Christmas. We might take a day or two off over the Christmas period, depending on what's going on. But thank you for spending time with us this evening. Take care. Have a good evening. And I look forward to seeing you next time. This is Martin North from Digital Finance Analytics signing off. Take care.